For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another Saturday Sendout from the Simple Side. I know I took a little bit of a hiatus there from the podcasting, but we're back with it today. We're going to run through and do a quick look at the past week in the markets and what we see coming up over the next couple of weeks. We'll see you in a second.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste.
All right, everybody, welcome back to the Saturday Sendout podcast from the Simple Side. I'm excited to be back in podcasting mode with you all, and we are going to jump into everything quickly today. It's going to be a quick podcast. We're just going to talk about everything that happened over the past week in the markets. And then, of course, paying subscribers, you have access to all of the weekly picks in today's newsletter, which again, over the past 52 weeks, over the past year, it's been 1 year and 1 week since we started doing this, we've returned over 60% to those of you that have been following the weekly trades. And we are going to continue to do so over the next year, at least we hope, and you will be around to see it all. All right, let's talk weekly commentary. Over the last full week of July, we hit new highs for the S&P 500, fresh intraday peaks for the Nasdaq, but the real story was sat beneath the index level calm, an epic tug-of-war between exuberant AI spending and profit warnings in healthcare, and a surge of big ticket deal making that could redraw several industry maps. The big picture, equities are on higher ground. Monday's trade deal optimism with the EU and Japan set the tone, and it never broke. Even treasury yields inched back toward 4.4%. The VIX slipped under 15 on Friday. If you don't know, the VIX measures volatility, and it usually rockets higher when the market is struggling. This suggests traders have once again written off summer volatility. Breadth, however, stayed thin. More than half of the S&P 500 members finished the week in the red, and chip makers who carried the spring rally ended in the red. It was surprising to see that happen, but it had to happen at some point. You can't go on a rally forever. Oil drifted towards $65 a barrel despite OPEC cutting exports. This does help with inflation narrative, but of course it does pinch energy shares and bring a lot of those companies lower. Good time to enter into companies like ConocoPhillips, Occidental Petroleum, things of that nature if you're in that market. All right, let's talk about the three biggest themes that mattered, at least in my eyes, in the market over the past week. AI infrastructure arms race is going global. Google just spent $1.2 billion on a 5-year cloud deal with ServiceNow, which of course is showing how aggressively these hyperscalers are expected to grow. ServiceNow is obligated to spend almost $5 billion on cloud services through 2030. T-Mobile, Verizon, and Crown Castle, meanwhile, all cited President Trump's expedited permitting order for the data center buildouts as a direct earnings tailwind. Intel tried to keep pace by unraveling an $18 billion CapEx plan with a pivot to contract manufacturing. Very interesting there. The consequences are twofold. Back-end providers like Digital Realty or Baker Hughes turbine unit now have visibility that they have not enjoyed since the heyday of shale, but now every CFO faces a capital allocation dilemma as AI costs collide with shareholder return promises. It's going to be an interesting one for them, but we did see Digital Realty and Baker Hughes run up on the news. No surprise there. For those that don't know, these are both companies that exist in my contrarian trades portfolio, which is betting on the second wave of AI effects. And that is basically a big bet on energy becoming a big deal. And we've seen a lot of those stocks start to run up wildly in recent weeks. The second big thing is reshoring and the tariff carousel that has been happening. One thing that we did see is Apple's $500 million prepayment to MP Materials for US-made rare earth magnets, and BHP's battery alliance with CATL and BYD tell the same story. Supply chain security is now a balance sheet line item and should be expected to be so furthermore as long as Trump is in power and the relations with China struggle. Intel is consolidating fabrication projects in Vietnam and Malaysia while freezing European projects until it sees what Brussels does with the proposed chip subsidies. Of course, good news there means a lot of things moving to the EU. Bad things, of course, mean more happening in Vietnam and Malaysia. The White House floated a 15% reciprocal tariff on the EU and Japan, which Japan's market seemed to have loved. This has been temporarily soothed by the talk of agriculture, and auto quotas, but the message is quite clear. Corporate planners should assume the 1990s trade framework is gone for good, at least during Trump's term. And the third big theme for this week is the merger month that is going to be August. The FCC just signed up on Skydance and Paramount. More about that in our weekly picks for this week. Union Pacific and Norfolk Southern began fueling a transcontinental rail tie-up. Again, more about that in our weekly picks. Union Pacific, upgrade from Jefferies signals that investors believe regulators might bless at least one mega rail in the U.S., the combination to counterbalance the Canadian Pacific Kansas City rails. Of course, there is some healthcare news with companies buying back shares or accepting cash bids. And we've got Newmont, which doubled its repurchase authorization instead of buying another mine. Of course, that means that they think asset prices are inflated, at least in my view, and that they are going to be buying back their company shares instead of gambling on elevated asset prices, which could be good or bad news depending on whether or not you hold Newmont or if you think that everything is going to be bullish over the next few years. The next thing we're going to jump into quickly is our sector scoreboard and the consequences. Technology added just under 1%, cushioned by Google and ServiceNow, but held back by all those chip profit-taking actors. We've seen people like Jensen Huang taking money off the table big time, definitely signaling that asset prices are extremely, extremely inflated, and a good time to look at profit-taking as well, although things likely have room to run given all the deals that Trump has been coming out with in the White House. Samsung's warning has been that AI server demand is not big enough yet to absorb the lost handset volume. They're going to be struggling in the next coming months. If memory pricing does not improve by autumn, the semi-rally could lose a second leg of support, which would be bearish for all of those companies as well. Communication services, led the market thanks to T-Mobile's blowout subscriber guidance and Alphabet's large CapEx pledge. Longer term, we expect to see pairing high wireless cash flow with low latency data center traffic, putting a lot of people back into the growth conversation in the space. Satellites and balloon CapEx are going to continue to rise, hopefully bringing communication services up along with it. Healthcare, on the other hand, has been struggling big time. Not only have we seen issues with Centene and UNH and Elevance and Oscar, but we have more earnings coming up in the next week with United Healthcare reporting on the 29th, I believe, and this is going to decide whether or not healthcare is going to get absolutely demolished or if things have a chance to rise. If bad news comes from UNH, we're going to see more dropping in the healthcare sector. If not, things are going to rise, and it's going to look good for anybody that decided to bet on the healthcare sector early. Last but not least, we've got industrials, which rode GE's, Verona's, and Baker Hughes's data center orders, plus speculation that CSX or Kansas City Southern could end up in the next rail merge target. If Union Pacific and Norfolk Southern proceeds, expect the Surface Transportation Board to demand divestitures. Of course, short line operators could be hidden winners in that market. Macro and the Fed is our next big ticket item here. We've got new home sales that ticked up. Services like PMIs accelerated, and initial job claims fell to 217,000. I guess I said that in a weird way. 217,000. None of it, though, is weak enough to revive September rate cut bets. Core inflation is easing, but a sub 15 VIX and a record equity price leaves the FOMC little political cover for early easing. For now, the bond market appears willing to finance the AI data center boom with just under 4.5% on the 10-year. Now, should that rate back up meaningfully, the equities rally might become a bigger liability, but we'll see what happens there. What to watch for next week. Mega cap earnings are going to be happening. We've got Apple, Amazon, and Meta. They got to justify $300 billion of fresh AI capex. We have July payrolls, which are due on Friday. Consensus sits at about 185,000. We also have big AI news coming up with Capitol Hill. The Senate Commerce Committee is holding a hearing on large language model copyright claims, which is going to be a big deal for anybody in the news space and will also be a massive deal for Cloudflare, because Cloudflare has entered something called the pay per scrape model into their offerings to their customers. And if they end up ruling that that is what needs to happen, then Cloudflare is going to be a huge, huge winner on the outcome of that. The bottom line, momentum, liquidity, and the AI narrative continue to overpower valuation fatigue and policy risk. Basically, things are overvalued, but it seems like we're going to continue to get higher. Until breadth improves or bond yields break out, expect rallies to remain self-reinforcing and vulnerable to single headline reversals. And we've seen that all year. Since the beginning of the year, we've had single headline reversals, and that doesn't look like it's going to be slowing down at any point in time. All right, guys, I'm going to leave you with that today. There's a bunch of good stuff that you should go and read about in the newsletter. I'm telling you, it's going to be great. thesimpleside.substack.com. You can go and check out our weekly pick performance, which is interesting, but what you really want to look at is our interesting trade ideas. We've got United Health in there, we've got Apple, and one of the biggest things that I've talked about in a while is in the IPO world with Figma IPOing on the 31st. Listen, this is just going to be a big moneymaker for a lot of people. There's definitely going to be people that are going to take some money off the table, but over the next month, 2-month, year, 5-year, 10-year period, Figma is going to explode. The company's setting out at a valuation of $16 billion. And Adobe tried to acquire them for about $20 billion. So there's already a big upside there. At least 25% in the short term is what I see. And then there's definitely 10x potential over the next couple of years, just because Figma's valuation is going to be something like $16 billion. And Adobe, I think, is something like $150 billion. So there's definitely 10x potential for Figma in that space. Anyway, if you're a paying subscriber, go and check out all of the weekly picks we have for you this week, and I will be seeing you next week.